Welcome to tonight's asset protection webinar. I'm really excited about the topic and especially excited about the people who have been on. Rob and Nicole are just absolutely phenomenal investors and so much to teach us about investing. And so before we do, let me just go through a couple little housekeeping things. This is a series. If you're brand new to us, a lot of people are tonight. It's a series that's been going on for probably 10 or 12 years. I need to add that up sometimes, but just last year alone, some of the topics we covered, and some of the people we've had some amazing attorneys on, about protecting assets, about selecting the best entities, about cost segregation, tax strategies, nonprofit corporations. We had Kevin O'Leary, Shark Tank, Mr. Bald, wonderful. We've had some amazing speakers, and I hope if you're not paying attention to those, that you tune into these. All of these webinars that we've done are recorded, and they're generally, not 100%, but generally available the next day on our YouTube channel. And if you haven't subscribed, I encourage you to do that. You simply go to YouTube, type in Protect Wealth Academy, and hit the subscribe button. And every time we post a new webinar, you'll be alerted to that. And so pay attention to these, because not every topic that we talk about will apply to you, but we've had some really good topics, and we hope that you pay attention. The advantage, obviously, of attending live is that you get to ask questions and you get to hear everyone else's questions. And yes, there's a recording, and we appreciate that, but we find that very, very few people ever listen to the recordings because you didn't put a lot of time in the first time, and I'll get to it, but we never do. And so I don't know, and I'm very much that way. Unless I take time and carve out time and put this on my calendar, I generally don't get around to it. So we encourage you to do that. Of course, we run the longest 3-day asset protection summit anywhere in the nation. And we're very, very proud of this and the speakers we've been able to work with over the years. I feel it's a brain trust of some of the best, brightest minds in the asset protection industry. Clint Coons and Scott Estel, former senior trial attorney from the IRS, Mike and Stacy and Kwame, and every speaker or every summit we do, there'll be a different lineup of speakers. We always switch things around just a little bit. The core content does stay the same, although it's always progressing. New tax strategies, and we just learned this, and we're doing this now. And a new court case came down, which alters a little bit how we're doing things. Tax laws are ever changing, and so we change the content every single summit. And so if you're paying attention to that, there'll be some new case studies at this next event. It's brand new tax year, so we're going to take advantage of that. The new schedule will be posted probably next week. But there's a sample agenda if you'd like to see it. And you'll find out that this is not a wussy little seminar. This is it's full of content. It's so good that if you are a CPA, if you're an attorney, almost always you'll get continuing education credit. It's that good. But it really wasn't designed for them. It was designed for the average business person, the average real estate investor. We hope you take advantage of that and sign up. The 2 classes that we've got coming up, I think, there we are, February 6th through 8th, which means we're 3 weeks away right now. If you haven't signed up for that, please put that on your agenda, and make the beginning and the end of a tax year is always our busiest summits. And sometimes right around tax time, people get interested. But the very first part of the year, we can still create entities and backdate them to January 1st. Sometimes we have some limitations when it comes to taxes, but there's a lot that we can do at the beginning of a year to get you structured properly. And so again, take advantage of that. Okay. We're doing a tax and legal workshop. There's always a tax and legal disclaimer. We can't give tax advice. We can't give investment advice. We can teach correct principles and then let you kind of figure it out, but always meet with professionals. We don't promise any returns. We don't promise that this tax strategy or this real estate investment is going to work for you. And so always take that with a grain of salt. So but we always bring on people that have integrity, that teach correct principles. And so hope that makes sense. Okay. With all that under our belt, Rob and Nicole, so excited to have you guys here. And I think rather than give a lot of background, I just simply say a lot of our students, including myself, have had a hard time. I've always believed in having hard assets. I like having gold in or silver in my possession. I don't trust it somewhere else. I always like hard assets. I like having real estate. And Rob, you've taught me a lot. And in fact, I've learned a lot the last couple of years with my own investing, the difference between debt and equity. And so we've asked him to kind of come on and explain sort of the difference, but also maybe tell your story, how you got started with this, and maybe a little bit about what you do. Rob, Nicole, so excited. Thank you for being here. Kendall and I will be in the background for students. What they've kind of planned to do is do a kind of a prepared presentation that's designed to cover most of your questions, but we will leave time at the end for Q&A. So with that, Rob, I think you're unmuted. We're going to be in the background if you need something.
Okay. Thank you so much for having us. We're excited to be here. I'm not going to lie, a little intimidated after seeing all of the lawyers and the really, really professional, highly acclaimed individuals on there. We're excited to be here. And Mark Perry, hi. We saw your comment in the chat. We're excited to have you here. Mark's been working with us for a while, and he's a great guy. Before we jump into our presentation, I wanted to talk just a little bit about the fact that our perspective really dictates our truth. We know what we know based on the experiences that we've had, based on the people that we're raised around, the people that we spend our time with. And being a part of an organization like this, being able to come on and educate about things that we know, things that we've experienced, is always something that we enjoy doing, simply because through the process of starting our business 15 years ago and changing, the model of our business and changing the approach of our business at different times, our perspective has changed. And so the things that we know, we've grown in different ways. And so being able to share what we know with others in order to maybe help broaden your understanding and your knowledge about something that we maybe have a little bit more knowledge about is fun for us. And just to kind of illustrate this idea, when I was about 15 years old, I was on a family vacation, and we went to a restaurant, and there was an hour and a half long wait. We were in Southern California somewhere, and there was a Nordstrom next door. And so all of the girls in the family, it was my mom, my sister, some cousins, we left the boys at the restaurant to watch a game, wait for the table. And we went over to Nordstrom, and we went into the shoe department. We're walking around just kind of browsing. Well, then my 15-year-old self saw this pair of boots, and they were the most unique boots I have ever seen in my life. They were thigh-high black leather boots. They had fire flames up the side, and they were sitting next to a box. So the assumption that we made was someone tried on those boots, decided not to buy them, and left them there. So my sister and I turned to my younger cousin, and we convinced her to go try on these really funky boots. And so she goes, she puts these boots on, she's strutting all around the, floor at Nordstrom. We're laughing, we're having a great time. We're, just goofing off and having fun. And then she goes, she takes the boots off, puts them next to the box, And as we start walking away, we watch another woman who we had seen earlier, walking around trying on shoes. She walked over to that spot, sat down, took off the shoes that she was trying on, put them inside that box, then proceeded to put the leather boots, thigh-high, flame decorated boots on her feet, and then walk out the store. So our perspective in that instance, our knowledge was limited. The assumptions that we made based on the information that we had were incorrect. And I still to this day feel very bad that she saw us making fun of her boots. It's something that haunts me a little bit. But the idea is that we only know what we know. And so when we gather with like-minded people, with people who have knowledge, who want to share knowledge, or who want to learn, it's always a benefit. It's a benefit for us to be able to talk with groups like this. And it's a benefit for people listening. And we look forward to our Q&A at the end so that we can answer questions for you. So let's get started. We can share our screen.
Yep. All right. You guys see that okay?
All right.
I guess you can't tell.
So we are going to be talking about real estate basics. This picture right here, it's one of our favorite. This was a project that we did in Napa, California. It was just a total renovation. I think we left one wall standing because that's what was required to make it a renovation and not a new build. But today we are going to be talking about who we are. We'll tell you a little bit about our story. We'll talk about why real estate, what's the current state of real estate? Is there a bubble? Debt versus equity, just like Dawn was saying. And then we're going to talk about our process, what we do in our business. And we're going to share actually one of our projects with you. So we are a husband and wife duo. We get the question a lot, how do you work with your spouse? And we actually work fairly well together. Yeah. I think it was actually Mark Perry went on one of our last webinars that we did that he said, I think it's because you guys have common goals. I'm pretty sure it was Mark who made that comment. And we do. And
we didn't plant Mark. It just so happens that he follows, I guess, Don and Kendall, and then with another organization we're involved in as well that we've done meetings with.
So back in 2009, Rob and I got married in 2007, graduated from college, and I was working a sales job. Rob was working a sales job. He was actually on track to go to medical school. That was his plan. And he had always been interested in real estate. I grew up in a very fiscally conservative household. My parents still wrote checks at the grocery store because they didn't want to use credit cards. Just because they were afraid of, not being able to keep track of, not that they couldn't keep track of money, but just, spending more than they had. And they were very careful about ever being in debt. And so Rob comes to me one day and he ultimately decided against going to medical school, which was a good route for us personally. But he came to me one day and he just said, I had a little bit of money in the stock market. And he just said, how would you feel about taking that money out of the stock market and buying a tape of properties from a bank? And this was in 2009 when banks were trying to offload properties. We had the crash and a lot of foreclosed properties. And so we actually bought our first tape of properties. It was 13 properties that were scattered all over the US. And we, with very limited knowledge and resources, we figured out how to rehab those properties from a distance, find contractors in the areas, and then get renters into those homes so that they became cash flowing properties. And we sold some of those properties off and then held on to others so that we continued to have that cash flow. But we sold some so that we had money to then go and purchase more properties. And as we started doing that, we both kept our day jobs. We started a family. We had 3 children during this process. At one point, we were buying between 30 and 40 properties a month and managing the flip and the leasing. And we've owned a property management company for a time and decided that was not for us. But back in 2015, it started getting harder to buy properties that were going to, we always say, you know, you make your money on the purchase of a property. So if you can buy it for the right dollar amount, then you can move forward and it can be a profitable project. But it was getting harder to do that. People were willing to spend more on properties. And so Rob started getting really creative. You know, how do we stay in this real estate space that we love and that we want to be a part of, but maybe not flipping 40 houses a month? And so he started looking at land acquisition and looking at raw land and building full developments. And so that was about 2015. And in 2016, we bought our we had our first land acquisition. It was about 830 acres in Colorado Springs. And from there, we have just continued to purchase land. That is what we do now. We buy raw land, we entitle it, we rezone it, I did that out of order. We annex it, we retitle it and rezone it. But so Rob serves as our Chief Executive Officer, if I can read. I'm just looking at some of our key points that are up here. Develops and builds residential communities. And we currently have over 10,000 lots in our pipeline. We've got 19 projects that are at various stages of development. And on top of doing all of the real estate, he decided a few years ago, he was using spreadsheets to analyze properties before we would purchase them. And he decided it would be beneficial to have a software that helped him analyze, you know, input all of those spreadsheets and let the computer analyze and figure out if properties would be a good purchase. And so he started Housefolios, co-founded Housefolios. He currently serves as the CEO on that as well. It's a real estate software, analysis software.
Yeah.
I'm tripping over my words. I work as the fund manager within ROI Property Group, and I am also the lead designer. So we do a lot of build to rent communities, and I work with our construction manager on pricing and design, choosing all of the fixtures and everything for each of those projects. I work one-on-one with our private lenders, individuals who choose to come in and invest with us. I also run charitable efforts. Giving back to our community is a big thing for us. It's something that we want to teach our children and incorporate with our business. And so that is something that we value very much. So we have just included in here a map for you guys to see where some of our current and past projects are. This is a project we have in Texas. We do work in Texas and Atlanta, Georgia. We've got a couple projects going on. This is that first project that we started in Colorado Springs. It's called Saddlehorn Ranch. And this is one of our Napa projects. We are from Napa, California. We've been living there the last 15 years, and we just a year and a half ago relocated to Utah, which is where Housefolios is located. And that was kind of what brought us here. But we did do a handful of projects in California while we were there also. And we also have a project in Alabama. That's the only other one that's not on our map here. So we are going to show you a video. Our marketing guy, Parker, put this together for us. We always do drone footage and photos for all of our investors and lenders. We do updated projects every month, and we send out a newsletter. And so he compiled a video for us to show you guys what we have going on.
Okay. Did we?
No,
There we go. Oops. Sorry, just making sure that we've got
I
that.
thought we skipped one. We're good.
So we couldn't hear any of the audio,
Oh, you're
but we
kidding
saw
me.
the video.
Oh, that's too
Oh,
bad.
there was fun music. I'm so sorry.
So if there's something that was critical that we need to know.
Nope.
but-
No, it was just music. It was probably not as exciting to watch without the music.
Okay, well, it was still good. Thank you.
Okay, sorry about that.
Okay, so one of the questions that we get asked is why real estate? There's a lot of reasons to be in real estate. One too many. So just to start with a couple of them, by definition, right? It's a real asset. As opposed to when, I don't know, some of you might have caught at the beginning, we were kind of bantering a little bit about crypto, which there are virtues to blockchain and things like that we kind of talked about, but there's not a tangible asset oftentimes. Whereas with real estate, you can see it, touch it, feel it. There's some value. Generally, it doesn't go to zero unless there's some sort of something catastrophic, whereas stocks can plummet. Real estate tends to be stable or more steady. It doesn't have the daily swings, right? Yeah. And so those are some of the advantages to that. As well, real estate, there are multiple strategies, right? There's buy and hold, fix and flip. There's the ability to buy something really early, like land, and improve it and sell it, or just
make it more valuable.
yeah, or just do nothing with it. We have a project right now that we bought a couple of years ago, and we're not going to do anything to it but sell it, and it's over double in value just because of some of the things that have happened around it recently. And so there's a number of different things that you can do with real estate that make it advantageous. There's lots of tax strategies. Obviously, you can leverage real estate in a way that you can't leverage many other types of assets, which makes it very advantageous. There's a number of other tax strategies we could talk. That's probably a whole seminar all to itself. And Don and Kendall probably done one with an accountant or a tax strategist for real estate specifically. But the nice thing about it is that, land is in scarcity. They're not creating more of it, as they say, and it's not going anywhere unless you happen to live in California like we did. And there was always the threat that we would float off into the ocean, right? People would say that from time to time. Obviously that's not happening, but also the nice thing about the real estate, it's a slow grower, but it tends to grow. But the nice thing about it, the potential for appreciation, is that you're appreciating off the entire asset, which, if you've done it very common way, you've leveraged it, generally 4-to-1 or so. And so you're actually appreciating off the entire value, not just your own equity. And so if you've put in $100,000 on a $400,000 asset and appreciates 5%, it didn't appreciate 5,000, it appreciated 20,000. So on your $100,000, you got a 20% appreciation on that dollar amount. But again, there's lots of reasons, but having a continual cash flow, passive income is what it's often called. But I will tell you that with real estate, and we've owned hundreds of rentals and done a number of things, but it's rarely fully passive if you own the asset, if you have equity in a deal, right? Because even if you hire a property manager, but somebody's got to manage the property manager. Hopefully they don't call you if a light bulb needs changing, but they're probably going to call you if there's something that's over $50 or over $100 that needs to be worked on, or the tenant puts stuffed animals down, their child puts stuffed animals down the toilet, or something like that. So also in real estate, why real estate? One of the things that, and this kind of goes right into the next slide, which is what's the current state of real estate. But okay, almost there. Okay. One of the key points that I always bring up is that the current housing shortage. Prior to the last recession, there was they had excessive amount of extra homes, right? A couple million homes that were extra. People would buy them and say, it's okay, I'm going to hold it for a year and then I'm going to sell it for a 10% increase or a 20% increase. And there were enough people doing that thought it was a good idea, that in the end, you had a number of vacant homes, and depending on where you live in the country, some of you may still see remnants of that, where neighborhoods were started and never completed. Homes, sometimes several homes were being built in neighborhoods, and that nothing was done with them. So, but that's the opposite now. There was so long, banks stopped funding much land, which is, again, one of the things that we've done a fair amount of. They stopped funding that component of real estate. And so we couldn't go to the bank and pull out debt on a piece of land. So it was much harder. The threshold to get into land acquisition and improvement was much, much more challenging. And so for a number of years, there wasn't really much of that happening. And so there's a significant shortage, and continues to be a significant shortage of homes, which affects both renters and buyers. So again, kind of one of those questions I get asked is, what's the current state of real estate? You've probably already gathered this, but I'm probably the less interesting of the two of us. I'm kind of a data geek, and I'll go through studies and things like that.
You need both though, right? Like, you need both.
Yeah. But Nicole's more fun to talk to. And so that's why also she interacts with a lot more of the investors and lenders and things like that. So one of the things that we've seen already, obviously rates have increased, they went up again. They're continuing to increase. The CPI, the inflation is looking like it's coming under control, but essentially with these increased rates, people haven't really adjusted to the new normal, right? That rates are higher, and hopefully they come back down in the next year or so. But there's going to be some time frame that they're at. It takes people, the statistic I've heard is about 12 to 18 months. And that's kind of realtors have talked about that as kind of what they've seen through past cycles. There's this new kind of general getting comfortable with the rates. And did you have something? Okay.
No, you did good.
Thank you. Atlanta, Georgia is an example of a market that we have a pretty strong presence in. We've got 6 or 7 projects out there, but year on year home sales are down 37% and home prices have increased. And then Colorado Springs, I was looking at the numbers yesterday. They didn't get incorporated in this because I think I got the data this morning actually for December. And the home sales are down tremendously, but the days on market, excluding the $1 million plus price range, right? The days on market for, say, a $400,000 to $500,000 home, which in that market is roughly the average home price, it's still it's less than 1.2 months. And 6 months is kind of considered a balanced market. Point with bringing that up is that you have the thought process was, hey, we're going to make the rates rise, at least in part, right? We make the rates rise, and there's going to be there's going to be more supply. There's going to be fewer people buying. Well, the problem with that is that so many people refinanced at 2-ish rate that they're not going to sell. Why would I sell today and go to a 7% or 7.5% rate? So they're just going to stay there. So it doesn't infuse more supply into the market. Really, a majority, not a majority, but a big chunk of it, a bigger chunk than normal of the supply is new built homes, which in a market where we're still undersupplied, we can't build fast enough. Now, even with all of that, of course, lumber, we've seen home building has slowed down, right? Because the big builders, D.R. Hortons, Lennars, those groups, they don't want to get over their skis. They don't want to get overextended. So they slowed down home building as well. So while the home building is a big chunk of the supply, or it needs to be, because people aren't going to sell their homes, those big national home builders that produce the majority of the homes are not producing as many homes. And for sure, home buying has slowed because people don't typically want to pay the high rate. They haven't gotten adjusted to that kind of new normal, as I said. So we have seen some pluses in the cost of lumber coming down. There's been some cost of labor coming down as well. Diesel is still up, but there's some movement downward on that. It's not been nearly as great. So there are some positive movements in real estate as far as where everything is at, despite the challenges of the increased rate. So.
All right, we're going to talk about investing with debt versus equity. So I mean, what is debt? When we talk about debt, it's basically a loan. So if you are coming into, you're fine. You can put all that out there. We're going to talk about all these things.
Okay.
Yeah, a debt investor is someone who comes in basically like you're giving a loan. There's usually a fixed rate. It's a passive income. And that is actually what we raise is debt. We're currently raising a debt fund right now that takes care of 10 of our projects. Like I said earlier, we've got 19 in the pipeline, but we have one specific fund that finances, I guess is the right word, finances 10 of our projects. They're all at various stages. But equity is more of an ownership position in an investment. So we did kind of a side-by-side comparison. There's pros and cons to both. We just prefer to work with debt. It works better for us. So debt is typically a passive income. Like I said, you give a loan and you sit back and you let whoever you lent the money to do the work. Whereas when you're an equity partner, it's an active income. You typically have to be involved in the process. That's not always the case, but it is typically more active than passive. With debt, your investment is secured by a promissory note or lien against the property. Whereas with equity, the investment is unsecured. With debt, again, it's that steady, predictable, fixed income that comes, however it is structured. With us, we structure it to where you get an annual interest rate, but that interest is paid monthly. So it's broken down into 12 payments for the year. And every month our investors receive their interest payment. With equity, it's an unpredictable return. There's typically no guarantee. There's, promise of hope for what that investment is going to turn into, but they are typically unpredictable. I feel like I'm boring just reading this. Sorry, guys, but with debt, so your return is limited to the contract rate. So if we offer 12% on your money, no matter what happens with that project that you are invested in, you get your 12%. So, some people say, oh, but if you make all this money on this project, I don't see any of the upside, which is accurate. However, if anything does go wrong, you don't see any of the downside either. With equity, the difference there is that you have unlimited upside. Because if you're invested in a project as an equity partner and it just blows up and it's amazing, then you're going to see a much higher return. Liable. Okay, so with debt, you're actually not liable for the lawsuits associated with development, construction, or any of the sales process because you're not an owner in the project. Whereas if you are an equity partner, you have unlimited liability. So you are on the hook for any type of legal issue that might come up. With debt, the risk is limited to the investment in the project. You're not obligated if something goes wrong with the investment. Whereas with equity, again, you have unlimited risk and responsibility for the principal and interest payments due to any other investors. As far as time frame with debt, there's usually a structured time frame, and it's typically a shorter holding period. Whereas with equity, it's typically unpredictable. It can be extended if anything goes wrong. And then tax implications. So with debt, all the income is considered passive and it's not subject to self-employment taxes. But the investor is not eligible for depreciation deductions either. With equity, tax implications are that the income is subject to capital gains taxes, but on the other side, the investor is eligible for depreciation deductions. And so sometimes that matters to people. And so it's kind of a double-edged sword. I mean, there's pros and cons to both of them.
We had an apartment complex that we bought in 2020, put it under contract in March of 2020. And we were thinking we're going to hold it for a while. And so we put it under contract in March, closed on it in October, took that long to get all the financing adjusted with everything that was going on in the market. And then we had a big kind of family office come along. We bought it for $27 million and a family office or an institutional group came along and bought it, offered us $10 million more. In 11 months, we sold it. Well, the first year we depreciated $8 million, which is a lot of money. And it was us, and there were several partners involved, but that we brought in as equity partners. But we had to recapture that depreciation in that year that we sold it, basically the year afterwards. The thinking originally was that we would have that depreciation and carry it on for years, but because you can front load a lot of that depreciation, it's really handy. except for when you have to recapture it all. And then you're subject to a big tax bill unless you have something else that depreciates pretty strongly. So again, like Nicole said, there's definitely pros and cons to each structure. Equity is nice in some situations, but I got to talking with Don and Kendall the other day as we were chatting about it. And one of the things that I found, at least, is that so many people, they want to not have another full-time job. Maybe that's the way I could say it, is oftentimes you're involved in maybe not a full-time or part-time job, but a lot of times they don't want another job, right? And one of the ways that debt investing has been kind of referred to is as being your own bank, right? You're lending the money, and most banks I know are doing pretty well, right? They tend to do pretty well even when things don't go well, generally, but that's not always the case. But anyway, that was my thoughts about that. So one of the things that Kendall had asked me as we were looking is how we choose a deal. And I'll be fast, because a lot of it is we've chosen markets, and anybody who wants to go and do this type of thing, they have to define a market that they feel comfortable. And things we look at is economic growth, our businesses moving in and out, and our people moving in or out. Those are the two things, right? And usually if businesses are moving in or out, people are following that because businesses employ people. And so government hubs with other jobs bringing them in are good. And then, so that's kind of market, and there's a lot more into it, and we can maybe go into more another time, but analyzing specific opportunities. We have, Nicole mentioned our software, but I have a full-time analyst on staff that we will present deals and say, here, underwrite this, go and check the market. And I have a full-time construction manager who will check on costs for materials, and in concrete might be different in California as it is compared to Alabama or Georgia or Utah or Colorado. Every place has different costs for materials depending on shipping and depending on how readily available it is. And Curb is on that, but that's kind of involved depending on whether or not you're buying an asset that's existing or you're building. We build all our stuff is new now, pretty much. We do have a little branch of our business that still does fix and flip, and it's maybe they're doing 5 a month now. It's not a large number like it used to be, but so how it looks or how you're going to make it look, how does it fit into the area? So those are all important. So I'm just going to present this all kind of moving forward, but I kind of had mentioned it earlier, but we can sell at many different points. We'll sometimes acquire land and not do anything to it. And there's an opportunity to sell within a couple of years if there's other opportunities or other buyers. Or we'll take it through entitlement, annexation, rezoning, entitlement. Once that's done, it has a value increase. Or we'll take it through horizontal development. And once that's done, there's a value increase. Or vertical construction. Once that's done, there's a value increase. So every kind of step along the way, there's a number of different lending opportunities, but essentially you can sell the end buyer the product like that nice house there, or you can hold for cash flow. And holding for cash flow is a great opportunity. Again, you're going to depreciate assets, you're going to do leverage and all these things, but I rarely refer to it as passive, especially if you have more than a few, it becomes a full-time job. And so we have asset managers on staff who manage assets, that kind of thing. And that is something that is not a short-term thing, right? It's throughout the life of the project. This is one of the projects that Nicole mentioned actually earlier, Huntsville, Alabama. We broke ground on this in November. It's a 155 unit community. It's a build to rent. We do a number of build to rent communities. Sometimes we'll sell the entire community to other buyers. Sometimes we'll sell individual units, but mostly it's entire communities now. So let's run through this. I'm actually having a hard time seeing this. Let me see if I can we move that? I think this little deal has been right in the middle of our screen where we see everybody. It's been right in the middle of our screen for a while. So hopefully that works, but now I can't see that either. I'm sorry, everybody. It's the hard thing about Zoom. Okay, there we go. Okay. So if we were to do a project with 100% equity, this particular project is a $45 million budget. These are some of the costs there, right? So I'm going to break this out. Essentially, a property, we were talking about equity versus debt. An equity multiplier, unleveraged, meaning that how much we would make if we hold it. And this is a 5-year kind of hold all equity situation. IRR is 14.13 with almost 3 times the money that on that one, equity multiplier unlevered. That number doesn't seem quite right, but anyway, I apologize for that. But if we were to take debt, we can take 25% equity and 75% debt, and essentially kind of see how much difference there is. But the amount of dollars that you put in and the profitability. Oh, that is the net profit. Okay, my fault. So those numbers are correct. So essentially, by building it, you're building in equity just by going through the steps, and then when you sell it, if you've levered it, you see much greater return on your investment. And we kind of talked about that with the $100,000 investment in a $400,000 home appreciation.
You went through that really quick.
I did. We were kind of shorter on time.
I know. I want to make sure that we have time for question and answers. So why invest with us? Like we've talked about several times, we raise debt. We choose to do that because there's no uncertainty about the returns. Returns are fixed. The investor doesn't have to participate in any downside. Like I said earlier, our investors, get an annual interest, and that interest is broken up into monthly payments. Every single month, our investors get paid, and we have found, because we haven't always done it that way, but we have found that investors, they just feel more comfortable. They feel confident in the project when they see, oh, they told me I was going to start getting paid on this project, and I am getting paid on this project. It builds that level of confidence, and making our investors happy matters to us. And so that's what we like to do. It's a passive way to invest in a diversified portfolio. I've had a number of private lenders come to me and they say, well, I just want to be part of lots of things, but I don't know how. Our debt fund is a perfect way for you to come in on 10 different projects. They're, in different areas of the country. They're at different phases of development. We work with accredited and non-accredited investors. We do have a $100,000 minimum investment to get started with us. After that initial investment, if you have additional funds that come your way that you want to invest, you do not have to have an additional $100,000. You can come in at any increment after that. And we very often have investors come in later with more funds. Right. If you don't have all that cash just lying around looking for a place to go, we do work with IRAs. We work with 401ks all the time. Yeah, all the time. We have people coming to us and investing through those entities. Mark,
how funny is that? Another coincidence.
We wanted to share just a couple quick testimonials. We've got it.
I'm going fast here.
We're going really fast. These are people who have been with us for a long time. Mark's been with us for several years. John Helmick has been with us 12.
I think Mark only invested with us last year.
Was it just last year?
Last year, yeah. But Al and Cindy have invested with us for
like
12, 13 years, something like that.
Yeah.
John Helmick actually has a firm out of Oregon. They've been investing with us. He's got 15 million with us. He's a Yale law grad. He does his homework. He's
and that is not our typical investor. Our typical investor does not come to us with $15 million.
he's by far the largest, but
yeah.
I share that only because he's done his homework and anyway, he has a webpage. You can check him out as well, Gorilla Capital. And then Linda is another great investor lender that we have.
Yeah. So if anything that you have heard here tonight sounds interesting, if you want to learn any more about what we do, you can go to protectwealth.com/ROI, or you can go straight to my Calendly link. Once you go there, it'll take you to my open schedule. Choose a time, we'll schedule a one-on-one call, and it'll be with me. So myself, we'll do a call. We can talk about the fund that we're raising for. We also really like talking to people about what their goals are, their financial goals, and if we are a good fit for each other. Working with private lenders is something that we really enjoy because it's a symbiotic relationship. We have police officers and nurses and university professors and so many people from varied backgrounds that invest with us, and they're constantly telling us, I can't find these returns anywhere else. Thank you so much for this opportunity. And for us, being able to work with people and give them a return that they can't find other places, that's what this is about for us. So if you are interested, please, again, go to protectwealth.com/ROI or write to my Calendly link there, and we can schedule a time to talk. And I think now we'll turn it back over to Don.
Yeah.
For any.
Okay, well, I'm here. Okay, so we got an email question from Bob, and he's asking what you look for, aside from what you're offering. What do you look for to make sure that an investment is secure? If this is you've done a lot of investing. How do you make sure this is all I have to invest, or I don't know, you probably wouldn't do it, but I've worked hard for this money, and I'm a little guy, and I just want to make sure that what I have is secure. What do you look for as an investor?
So one of the things I can say that, it's tough, but well, first of all, you're right, Don. If we always want people to feel comfortable, and if there's a level of discomfort, we're going to tell you, then don't do it.
Absolutely.
We want you to feel comfortable. But one of the things I was going to say, in looking for an investment, the most important thing is the people you're investing with, because you can invest in the absolutely most secured asset, lean, it's 25% loan to value, all of this stuff, and then them not performing, and they don't
or
do
just
something
be dishonest or
be dishonest. Yeah. And so there's a number of different things. So one of the things I would say is pay attention to who you're lending or investing to.
Yeah.
Right. We have partners on a lot of our projects, meaning that they're individuals we worked with in the communities that we're in. And we're just last year, I had a guy who brought me several thousand lots that he was doing, and met with them, and it was things where, sounded really great. And then it just didn't feel right. And I got to spending more time with him, just kind of getting to know him a little bit. And I decided not to work with him. And in hindsight, that moment you think, I'm passing up a really good opportunity, and it's a little bit scary. You're like, oh, am I missing this really great boat? And the answer is sometimes you do, right? Sometimes you do miss a good boat, but going with your gut on that. And when you meet people, when you get to know them, it's sometimes you dodge a bullet too.
Yeah.
And so getting to know that, making sure the project is good, or the projects are good, really checking and making sure the numbers are there. There are certain markets that I don't invest in personally. It's not that they're bad markets, but they just don't really mesh with what we're doing and what we want to do and what we want to achieve. Early on, we invested in kind of rougher neighborhoods because it's what we could afford to do. Yeah. Now I don't do any of that. And it's not that those neighborhoods don't deserve us to, fixing up the neighborhood, but it's, on paper, they look really good. 30%, 50%, 100% returns. And then when you actually get through to them, they don't return like they say they're going to, and partly because things on paper can look a lot different than reality. So some of that is take a measure of, okay, where am I getting involved in? What does that look like? How is this? Does this community need more homes or more commercial buildings? If that's what you're doing, more apartments. Is it a good product? Is it a good operator who can actually get to that end result that they say they're going to get to?
And I'm really glad you said that, and what you said about people. Jay Mitten, my kind of mentor and trainer, great attorney, the father of asset protection, said contract is only as good as the people who you're working with. Yeah. I don't care what kind of contract it is. He didn't rely on contracts, he relied on people. Okay, so Mark, one of your investors, is saying, have you seen supply chain issues improve over the last few months? And if not, when do you anticipate an improvement? I think you sort of answered that a little bit.
Yeah, definitely. We've seen improvements. Cost of diesel is still affecting that though.
Yeah.
So it's still affecting that in the sense that it's made things still more expensive, but we've definitely seen things that were harder to get a hold of. I mean, at one point you guys may have heard garage doors, windows, lumber
Yeah.
was hard to get a hold of. Some of that happened because you had groups who were buying and ordering things and then hoarding it in case they needed a lot later, right?
Like toilet paper.
Right, bag toilet paper back in the all of us have experience with that, even if we don't have experience with lumber, right? You go to the grocery store and you turn down an aisle and there's nothing. You're like, how is this possible? Right. And anyway, so yeah, but things have gotten much better.
Okay, so we got a bunch of questions coming in. We're going to try to get through them. Akbar, is the money on a specific offering going toward one single project or to go to the pool? I think you answered that as well. You're pooling a lot of projects together.
And we do have specific offerings that we can do. They generally are a little bit less, because what ends up happening is when we do that, we'll end up raising more than we need right away because
we figure out how much we need and then we just start raising for it. But what happens when we do those project specific raises is we don't need all that money at once. But once you start raising, it's kind of hard. Oh, well, give me a month or two, I'll come back to you. We don't want to lose interested investors and momentum. So we end up getting all this money that we need, and then it sits and we're paying interest on it. And it's just sitting in our bank account. It's not actually being used.
Yeah.
And so we've gone back to a fund, which is what we've done in the past, was always just a general debt fund. And so, yes, the fund I keep not knowing what word to use. Overseas, takes care of 10 of our projects right now. And it makes it a lot more flexible for us to be able to, Bradley Ridge needed 100,000 today, and tomorrow Templeton Gap needed 50,000. And we're able to move that around, as opposed to we did a project specific raise and that money cannot go anywhere but to that one project.
Right. And we can do,
but from an investor's point of view, I'm more diversified as long as you're investing in lots of different things.
Right.
And some people really like the idea of being in that first lien position. So we do offer that occasionally with people. We still kind of steer towards that. But when we do that, the rate drops because we know that some of that's literally going to be sitting in the bank for months.
Yeah.
Because it's not, raising from private individuals is not the same as raising from a bank, right? Because if I go raise from a bank, I do the work, I get reimbursed that month. I only pay then from that point on the money I've drawn. Mm-hmm. Whereas if we raise it from a bank, we're raising, $6 million. From private investors. We may raise $6 million for development and home building on a project. And then we just have a lot more kind of interest that we have to pay. So it's just kind of
functionality.
Yeah.
For the
risk
business.
Balanced, right? There's a little bit more risk in a debt fund, but there's also a bigger reward as well.
Okay. Susan is asking, what's the difference between an accredited and a non-accredited investor?
Okay, so there's a number of stipulations, but just for an individual, kind of the easiest ones are not including your home if you have a net worth over $1 million, or then you're accredited, or I believe it's 250,000 single and 350,000 married annual income. And Don, you probably know better than I do on that one.
That's okay. Back to Akbar. Do you take hard money loans for the projects, or is the finance exclusively from these private lending?
We generally try to do the private lending. And then when we get to a phase that we are maybe at the time we're going vertical, for instance, I'll give you a specific example. On Verde Commons, we close a bank loan. And at that point, if we've got a lot of investor debt, that amount of debt will diminish. There may still be a portion of it called like mezzanine debt, which is kind of like a little bit of a gap, but it diminishes because bank debt on the loan we closed last month was at 6.5%. The loan we closed this week's at 6.7%. So at that point, that it gets diminished substantially.
Okay. Amara is saying, is it possible for foreign investors like Canadians to invest with you? Are there any tax implications?
Yes, it's possible. Tax implications for us, there's no tax implications for us. So far as I'm aware, for her, I don't even engage in trying to tell people the U.S. tax implications. I always tell people to talk to their accountants.
Yeah.
So I don't
Okay,
even want to begin to answer
So
that
Amar,
question.
let me deal with that, because we're going to have an attorney from Dallas, Texas on here in a couple of weeks. We're still trying to get a date, but that's what he specializes in, is how to move money into it without patriating it and without having. So might you need a US corporation? Yes, but then you need an ITIN number. And so we're going to cover all that, and how do we go about doing it? And so the answer is yes, very much, but wait a couple weeks and we'll cover that. I promise you. Okay. So will there be opportunity for hybrid type of fund that has benefits of debt and equity?
We're like,
That's a challenge. So they're viewed very differently. So with IRS, I mean, right? So generally it's one or the other. I'm trying to think if there is a time when it's debt in the sense that you're getting a monthly payment. That's kind of pref equity, but that's what you're getting from debt. I don't know that you do have that same, because they're taxed very differently. So for instance, this week, I know my accounting team, we've got 3 people on our staff. They've been busy cranking out the 1099 INTs and NESs and everything else. Those go out by the end of January 23rd, I think is the date. I think it's the end of this week. And they're cranking on it, right? Whereas if you're an equity investor, it's a very different tax structure. It's K1, it's due by March 15th. And that you're calculated into the percentage ownership of the entity. So there may be more to unpack there than what I'm understanding in the quick question. But they're very different types of assets and how they're taxed and the implications. So I don't know if there was a specific thing that he was looking for.
Just asking if we
Okay.
were doing a hybrid.
How about the safety of the investment? Do we have is your investment secured by the property, a lien against the property? Is it personally guaranteed? How is the investor investment safe? And is it liquid?
It's not liquid. Generally, real estate's not that's one of the handy things about stocks, right? Is you say, I need to take 50,000 out, right? In real estate, it's not as easy as that. And the money it goes to building it up, and then we sell it, and then there's money. But even in selling an asset, you put it under contract, and 45 days later it closes, maybe, and then it maybe gets extended. So there's not even a reliable liquidity. I usually tell people that invest with us not to plan on spending that money or using that money until they have it in their bank account, and then think about what you're going to do with it. Because if you do it beforehand, so the liquidity is not there.
But the safety, we do a personal.
Yeah, we do a personal guarantee, but then also the fund has those assets on their books.
Mm-hmm.
So
okay, so it's secured by the fund and a personal guarantee as well.
Yeah.
What type of return are you looking at?
So in our fund, if you come in at that, we do a tiered system of return. So if you come in with our minimum of 100,000, we start at 12%. Mm-hmm. If you come in with 250, it raises to 13%. At 500,000, it goes up to 14%. And then anything $1 million or above is 15%.
Right. So we had a gentleman that came in, and he's like, okay, I'm going to do 200. And then somebody else had said, oh, if you get to 500, you get to this. So I was at an event. So he wrote me a check. And then I said, well, I don't know if you know this, but if you get to $1 million, it goes up even more. And he goes, oh, and so he pulled out another check, and he wrote another check, right? That's not most people. I get it. No. I don't have that kind of money laying around, right? But the structure is kind of tiered to incentivize people, because it's easier for us to work with one person who has $1 million than 10 people who have 100,000. And so it is incentivized that way as people grow to put more funds in.
Okay. So if my life savings account amounts to $105,000 in my IRA, is this a good investment for me?
Ooh. That's, I mean, I think it's good, and I think it's safe.
I was gonna say, we like it, right?
It depends on your goals. Yeah. Right.
But it's also all your eggs in one basket. And if that's all I have, it's everything I've got in one investment. What would you tell somebody, Nicole?
Oh, I always tell people I cannot give them actual advice on what to do with their money. I can present them the information. I can tell you that we have a lot of people's IRAs and 401ks. I know we personally have all of my parents' retirement.
And my parents
and your
as well.
parents' retirement. I just had a call on Friday of last week, a woman who came to us, and she and her husband had sold their business. And she said, I've got $1.5 million and like, that's it. There's no more money coming our way. And so we talked about things. She decided to do our minimum 100,000. And then this was a couple months ago. And then she reached out to me on Friday and she said, I want to put more in, but she kept saying, you know, this is all I have. Like, this is everything. And I said, friend, I don't want to say her name, but, you know, if you are not 100% comfortable with this, then let's hit pause. We do not need to move forward. She asked a few questions about different investors that we have. We talked about, you know, John Helmick and my parents and different things. And I said, but if you do not have that gut feeling that, yes, I am comfortable with this, this is a risk I'm willing to take, then we don't go any further. And she immediately just said, I feel better just hearing you say that you're not going to try to talk me into this. You're not going to force this on me. We do not do a hard sell. This is not, we are not going to convince anyone to come and work with us. That's just not our style.
Yeah.
Okay. Akbar says, do you have a portfolio of lenders to do a refind on the back end, or how long are the funds tied up?
The short answer is yes, we do. Also, when you do something, you can do agency debt. So these single family homes are structured like apartments, multifamily, even though they're single homes, because they're the whole community. They're looked at from banks like their apartments, like they're multifamily. So we can get Freddie, Fannie, HUD, all of those will finance our deals on the back end, and we've done a number of those. But in addition to that, banks chase these as well because they're great cash flowing assets. They've got good DSCR, which is a debt service coverage ratio. So they like the asset. I also saw that he asked about who we're using to build. I don't mean to skip around, so maybe I won't speak.
That's great. No, go ahead.
So he talked about Lennar, DHI is DR Horton International, LEN is Lennar, is that Pulte Homes, et cetera. So the short answer is we have used Lennar to build some homes for us in the past. We use kind of regional GCs is the best way to say it. So they're not small custom home builders. They're also Lennar and DR Horton and those guys have their own kind of agenda of what they're doing. Regional GCs, for instance, Rubke Construction is one, Beltan Homes or Beltan Construction in Georgia. Those are both builders we use in Georgia that have the ability to construct. I mean, Rubke is two of our communities, so it's about 250 homes. And then Beltan has one of our communities that's 174. So they have the ability to build these. These guys aren't building 2, 3, 4 homes a year, but they're also not kind of Lennar. Because Lennar, we don't quite get their attention enough. We built with them. We can get it as long as things are a little bit slower for them, but they don't give us their full attention. And so with the regional GCs, we get their full attention. So
cool. Okay, so somebody comes in, they've got 50% down and 50% in their 401k.
Yeah, that's no problem.
Yeah, we have people who, I mean, we've had some people come in with like 4 or 5 different entities. They had like $5,000 here, but 40 here and maybe 10 here. And we work with all of it.
Yeah.
Whatever it takes. How long do you have to wait for the monthly dividends to come?
The next month.
Yeah.
Once
it's an interest payment, just like we're borrowing from a bank.
Yeah. So your first month's payment might be less just because if you came in on the 14th or the 15th or something like that, you know, it'll be less than a full month's payment. But yeah, it starts that very next month. Okay.
The $100 minimum investment that you mentioned, is that the minimum for both the equity and the debt investors? Do you acquire it? We answered about you take non-accredited investors as well.
Yeah, we do. Yeah. And then we're not taking equity investors right now. So that's just coming in on the debt side is that $100,000 minimum.
Do you buy lots from wholesalers as well?
No. I mean, that's not a hard no. It's just that we never have. We haven't needed to. So, and we
Most
don't generally buy
wholesalers are
lots.
dealing,
We usually buy big community, big parcels of land. I'm sorry, go
yeah,
ahead.
the scale of okay, got it. What's the typical time horizon on the fund?
If you're asking like how long is your investment, we look for 2 to 5 years, and we let our investors choose. Some people don't want their money back after 2 years. Some people want to see how it goes, and they want the option of taking their money out at 2 years. A lot of those people at the same time say, but if I decide at 2 years, I don't want it back, can you keep it? And yes, we can extend the loan.
And the rate of your fund depends on the investment, 12 to 15%. Is that what you said?
Yeah.
Got
And
it.
I would say a lot of these questions, if you have questions, honestly, go to that link and hop on the visit, or it's protectwealth.com/ROI and sign up and visit with Nicole one-on-one, and she can answer most of these questions
Most
together.
Some of them I've been like,
I'm just going to go through it because we've already answered a
Yeah.
lot of these questions, and that's really good. Okay. If you notice something here while I'm deleting some of these redundant questions,
So one real quick point. I don't know if I can respond to this, but Vivek Das said, for potential investors, what marketing material can you provide other than this presentation? We do have a presentation that Nicole puts together, but honestly, go to our website, roipropertygroup.com, and you can see, click on the team, click on the projects.
all of our projects have an about page and an update page. And they're updated every month with photos, typically drone footage as well.
Depends if there's been enough changes, but
Right.
yeah. Mhm.
So yeah, you can see, but yes, if you schedule a call with me, I will send a pitch deck to you that takes you through each of the projects that is included in the fund and gives you a little bit more specifics.
And to answer the questions on there, we can share all the pro formas for all the projects that are in it. Some people like to get detailed. Some people don't like to get detailed. So if they're all there, they're all in the pitch deck that has a slide per page that has a summary. And then we can share specific project pro formas for every project that's in there.
We
Okay.
aim for transparency.
and so for students, Protect Wealth, what we're here to do is teach education. We're not here to push any one person's fund or anything else. We're saying these are we love working with Rob and Nicole because they're straightforward. We love what they do. We love so whether you do their investment or not is irrelevant to us. But we brought them as an example of here's the type of people you should be working with. And whether you have enough money right now, or whether your money is tied up with somebody else, or whether you just go a different direction, I don't care. But I hope that this has been educational. Thank you for that little heart. Because I don't have a dog in the fight, one way or the other. We want our students to understand that the value of education is what it is, and these are good people we trust. And so I hope that the education has been helpful. Okay. Any other questions? We're down to 4 or 5. Have you ever not paid an investor back from their investment?
Nope.
No. That is
Cool.
not-
I can say that not every project has been successful,
right.
and there's a difference between that. Anybody who can't say that, if they say, "Oh, every project's been successful," they either haven't done enough projects or they're lying, right? So not every project is successful. But when we were flipping 30 to 40 homes a month, we'd have our contractors go in and budget it and do all that, and then there was asbestos in the walls that they didn't anticipate or whatever. There's things like that happen. We value our lenders and our investors to the extent that we will pay them back even if that project is not successful. One of the reasons we like the fund, and you can see the pro formas on these projects, because we get land early. We have big gains in that. So when we sell them, there's plenty of profit to pay everybody back, even from one. We'll oftentimes pay two or three projects lenders back, if that makes sense. But there's a lot of profit in these deals. But we value our lenders and investors, and it's not worth burning the bridge on this little thing and say, oh, well, that one lost money, I'm not going to do it. I couldn't sleep at night like that. So we always pay people back, even if that particular project doesn't go well.
And our skeptic Akbar is saying, follow-up question to the fund. Where does the money to pay the interest from the investors come? Does from the fund itself or from outside sources? Good question. So Rob, straightforward.
We're not selling crypto. Is that what you're asking? We're going to sell our crypto coins.
I think that was sort of pretty much. It's not a pyramid scheme. It's a simple investment.
Yeah.
Anyway.
So, but hey, Akbar, if you want to know more, we're happy to hop in with you. Just go sign up with Nicole. We can get into a lot more of the details. And those are great questions. I mean, it's legitimately people want to know that what they're doing is something that, they're not putting it in and then we pay 5 years or 6 years interest off that. And then we disappear. Right. To skim 30% off the top and then keep the rest in there to pay interest long enough that we get an escape plan, right? That's not the deal. For us, we're very involved in building these projects, building communities, creating things.
And building relationships with our lenders. That matters to us as well.
Yeah.
But typically, I mean, we figure out how much money we need to raise, how much interest then we're going to have to pay.
Right.
And I mean, it's all part of our calculation of how much money do we actually need to make this function.
Okay, Nicole, will you put the slide back up? How do you get a consult with you?
Okay.
Okay.
Put that back.
And
here.
then simple interest or compounded interest over the
simple,
2 to 5
because it's
years?
paid monthly. There's nothing to compound.
Yeah. Simple interest.
Okay, cool. Yeah, we had a couple of those. And there's
2 to 5.
I wonder if I click that.
great. And okay, Julie, does this qualify for 1031 exchange?
No, it does not.
It does not.
And I will say that if people are looking for opportunities, we do have equity. Like we also have some of these units that people are like, hey, I want to 1031 exchange. I have property. We have 26 units that we're building in Colorado Springs that we'll be selling. You could 1031 exchange into 5, 10 of those guys if you wanted. Right. Cool. But we wouldn't be involved in it anymore other than, helping you get there. But at that point, it would be yours. And that there we have opportunities like that as well.
Is it because it has to be a like kind of exchange? You're going from debt to equity or equity to debt?
Correct. Yeah. If you're doing a 1031 exchange, that means you had equity in an asset. And this is not equity in an asset.
Yeah.
It's debt.
Okay, right at the top. Since the money goes into the pool of projects, do you provide a pro forma? I think you've already answered all of that.
We're happy to provide all of the pro formas for every project.
Of course you would. Of course. What's the length? You've already answered all that. Yep.
5 years.
John, got that. Do you take investments from multi-member LLC taxed as a partnership? If so, how long do the funds need to be seasoned in the account?
The answer is yes, we would take it, but we don't want to deal with everybody, right? Oftentimes we see this, people will do that in order to kind of get over me and my friend, we each have 125, but we'll put it together. We'll have 250, get the higher percentage interest rate. But the deal is like the whole reason we incentivize it that way is to structure it
individual.
Yeah, individuals. So,
but you said we would take it.
Yeah, we will. But I mean, that's because I can't be like, oh, there's 2 people in your LLC and I'm not going to split hairs. But yeah, it'll be their job to figure out who their managing member is and we'll deal with the managing member. How about that?
Well, I appreciate that. And so if it's a husband and wife multi-member LLC or a small, a small group, but if it's got to go to a committee, I would probably not want to do that either.
Yeah.
They can take it to their committee. I don't want to have to deal with, I don't want to take it to a committee. Right.
Yeah.
Whoever's in charge can take it to the committee. They can review it and do whatever they want to do.
Yep. You're right. That's the reason for the multi-member LLC is because you deal with the members. We don't. Right. That's good. But I think a smaller group would be interested.
Well, and in fairness, that's part of the reason for that is we've done that before. And then members from the LLC contact us and we say, who are you? I don't know who you are. Well, I'm a member of that LLC. Well, I don't even know that because I don't have an operating agreement that tells me every member of it. Right.
No.
And they had put in $25,000 and they wanted their money out now because they needed it for something and they were contacting me. So that's why I said that would be the deal, right? If they're going to do it, that's there. They've got to manage it, and that they've got to, I'm not responding to that. And I'm not trying to be mean, but then that's kind of a way to kind of the hurdle to kind of get over that $100,000 minimum dollar amount or whatever. And that's for them to manage, not for us.
Good. And thank you for your comments and your little hearts and your thumbs up. I appreciate that. One last question. Did she say what was the monthly ROI? And would you, Nicole, go over that one more time for us, would you?
So it's an annual interest rate, but we break it up and pay it monthly. So if you put $100,000 in and you're at 12%, you would get $12,000 that year, but you would be getting $1,000 a month for every month of the year would be paid out. So you're not earning 12% every single month. It's 12% annually paid out monthly.
Got it.
I'm laughing because I'm still amazed that Mark Perry's on here. Like, what are the chances of that? That guy he pops up everywhere. He's so fantastic.
He is.
That's great. He's a friend of, I mean, we didn't know him before last year, but he lives in Hawaii. He's just a great guy. Fantastic.
I think
about that.
We'll start seeing a lot more crossover with our students and your investors.
Yeah.
And we appreciate it. Closing comments. My closing comments is thank you for your time. Thank you for your expertise and clarifying for our students a little bit. Investments, we were never really taught how to make money. We were taught how to get a job, and the whole purpose of Protect Wealth Academy is teach financial education. And I am just an advocate that our school systems do just such a poor job teaching financial education. We graduate students without knowing how to balance a checkbook or the difference between an IRA and a Roth, or how to fill out a tax return, and so these types of webinars I think are important for our students. Thank you for taking time.
Yes.
Rob, Nicole, any closing comments from you?
I would just 100% agree with you. I wasn't taught anything. My dad was a colonel in the Air Force, physician. We moved around. I knew nothing. And a lot of what I've had to gain has been expensive through paying hundreds of thousands. I probably paid over $1 million in attorneys over the last few years. Right. And that seems like a crazy number, but with as much as we've been doing, we always make sure we're protected, but that's still a lot of money to get the education. And having webinars like these are invaluable to protecting yourself from predators. And unfortunately, the more you earn and the more you make, the more you have, you find those predators, whether you're trying or not, obviously. I mean, you're not trying, but you find them, they find you rather. And this is just a great way to protect what you have. So,
yeah.
As with all investments, be careful, do your due diligence on everything that you do. But Rob and Nicole are people that we vetted and we trust. And so, best of luck to you and all of you. Thank you for being on tonight, and have a wonderful evening.
Yes.
Thanks.
Good night, everyone. Thank you.
Okay. Good night now.